Okay, think about the last time maybe you signed up for a new credit card or applied for a loan, even, those buy now, pay later things you see everywhere. Did you ever stop and think about the safety net, like the actual rules working behind the scenes to protect you?
Probably not. Most people don't.
Right. So today, we're doing a deep dive into consumer credit. It's fundamental, isn't it? Touches almost everyone.
Absolutely. From store cards right up to hire purchase agreements. It seems technical, maybe a bit dry.
Yeah, maybe. But when you look at the protections, the story behind it all, it gets really interesting.
It really does.
Our mission today is to sort of untangle the laws, the regulators, the actual safeguards in the UK's consumer credit world. We've got some detailed source material, and the goal is for you to walk away really understanding this stuff without feeling, totally bogged down.
And what's fascinating, I think, is seeing how this whole framework has grown, how it keeps adapting to protect borrowers, often in ways people don't even realize.
So we'll connect the dots, right? Link the rules to like overall financial well-being.
Exactly.
Okay, so let's kick things off. The foundation. The Consumer Credit Acts.
Hmm.
We had the Consumer Credit Act 1974. That sort of laid the groundwork. Then the 2006 Act built on it.
Yeah, the core idea was pretty clear. Boost protection for consumers and make sure the rules fit the modern market.
And a big shift happened, didn't it, in 2014?
Oh, yeah. April 2014, that's when the regulatory power for consumer credit moved over to the Financial Conduct Authority, the FCA.
Right. Not just shuffling papers.
No, no. It signaled a much tougher, more joined-up approach to watching over the whole sector. A big change from the old Office of Fair Trading.
And these acts, they cover quite a lot, don't they? Lending money to individuals, small partnerships.
Yeah, specifically partnerships with fewer than 3 members.
Hmm.
But it's just as important what they don't cover.
Okay, like what?
Well, for instance, loans over £25,000 for business purposes, generally exempt. And most mortgages, the regulated ones, they fall under different rules. These acts are really aimed at protecting, well, what the law calls ordinary borrowers.
Ordinary borrowers. Although, interestingly, high net worth individuals can choose to opt out, right?
They can, yes, at their own request. It assumes they don't need the same level of protection.
Okay, now one protection I think is really powerful but maybe overlooked sometimes is the cooling off period, 14 days.
Yes, that's huge. It's basically a legal undo button. You get a written 14-day window starting from when you receive the agreement.
So if you have second thoughts.
Exactly. Buyer's remorse, or maybe you felt pressured, you just repay any money you've received, plus interest for that short time, and poof, the agreement's canceled.
A safeguard against those spur-of-the-moment decisions.
Precisely. But worth noting, there are a few small exemptions, like tiny loans under £50 or some small hire purchase deals, deemed too minor for the full works.
Got it. Now, the 1974 Act also introduced something we see all the time, the APR, the annual percentage rate.
Hmm. The sources we looked at called it the Act's most significant innovation. And I think that's probably right.
Why was it such a big deal?
Because before APR, comparing loans was a nightmare. Like comparing apples and, well, anything but apples.
Right.
The APR standardizes the total cost. It includes the interest rate, obviously, but also any extra fees or charges you pay when setting up the loan.
So you can actually compare properly.
Exactly. A genuine apples-to-apples comparison between different lenders. It empowers you to find the best deal. It's about transparency.
And if things do go wrong, if you have a complaint.
Then the Financial Ombudsman Service, the FOS, is where you go.
Yeah.
They offer an independent way to resolve disputes.
Okay, so that's the UK domestic stuff.
Yeah.
But there was also influence from Europe, right? The Consumer Credit Directive, the CCD.
Oh, definitely. The CCD had a really big impact on UK law.
Yeah.
It came in through, I think, 6 different sets of regulations.
And what was its main focus?
Primarily boosting transparency and strengthening borrower protections even further.
Like how?
Well, for example, it mandated that adverts for credit must show a representative APR example.
Ah, so you see the typical cost up front.
Exactly. It also brought in a strict rule that creditors have to assess your creditworthiness before they lend, not after.
Makes sense.
And they have to give you adequate explanations too.
Yeah.
Basically help you understand if the loan is actually right for your needs.
And clear information before you sign.
Crucial. Pre-contractual information has to be clear, easy to read, and given to you in good time. No last-minute rushes.
So that 14-day withdrawal rate we talked about, the CCD reinforced that.
It did, yes. Solidified it. And it also added that lenders have to tell you in writing about any changes to interest rates.
Okay.
And here's a really useful one. It allows borrowers, in certain situations, to seek redress directly from the creditor if they have problems with the goods or services bought with the credit and can't get satisfaction from the supplier.
Oh, interesting. So if the washing machine bought on finance breaks and the shop isn't helping,
You might be able to pursue the finance company. It links the credit to the purchase, offering another layer of protection, especially for bigger buys.
and even though the UK has left the EU, this influence kind of lingers, doesn't it? There's a second CCD?
That's right. Introduced in October 2023 in the EU, enhancing protections there even more.
Right.
Now, it doesn't directly apply here,
Oh,
obviously.
yeah.
But the UK government has said it intends to consult on reforming our own consumer credit rules. So you see this ongoing dialogue, these frameworks, learning from each other, even when separate.
Okay, fascinating. Let's switch focus now to the regulator, the FCA. You mentioned they took over in 2014. How different is their approach?
Night and day, really. The FCA brought a much more rigorous approach, significantly stronger supervisory powers than the old OFT.
So what does that mean for credit firms?
It means they must be authorized by the FCA. And that's not just a tick box exercise.
Right.
They have to follow the FCA's high-level principles for businesses. Things like acting with integrity, treating customers fairly, not being misleading.
And there's the consumer duty now, too, isn't there?
Absolutely critical.
Yeah.
The consumer duty requires firms to proactively deliver good outcomes for retail customers. It embeds that culture of consumer protection right into their operations.
Okay, let's unpack one area where the FCA really made waves. High-cost short-term credit, payday lenders.
Ah, yes. A classic example of the FCA stepping in very forcefully where there were clear problems, clear exploitation happening.
What did they actually do?
After a lot of investigation, they brought in very specific price caps. These fundamentally changed that market.
Like what sort of caps?
Okay, so first, interest is capped at 0.8% per day of the amount borrowed. Default fees if you miss a payment capped at £15 total.
Right.
And the big one, you should never have to repay more than 100% of the original loan amount in total fees and interest combined.
Wow. So double the loan amount is the absolute maximum you'd ever pay back.
Exactly. It stopped those terrifying spirals of debt where interest and fees just kept mounting up astronomically. Huge protection for vulnerable borrowers.
And this FCA authorization, it's not all the same level, is it? There's full permission.
Right. For the higher risk core activities, things like credit broking, debt collecting, debt counseling, peer-to-peer lending platforms, credit reference agencies, they all need full permission. It's pretty comprehensive.
And the alternative?
Is limited permission. This is generally for lower risk activities, often firms where credit isn't their main business. Maybe a retailer offering specific finance options.
Okay.
They need less detailed info submitted to the FCA. It's meant to be proportionate to the risk they pose.
So all these rules, principles, regulations, how do they actually come together for you, the consumer, day to day?
Well, they're all pulled together in the FCA's rule book, specifically in what's called the Consumer Credit Sourcebook, or CONC, introduced back in April 2014.
CONC. Okay, so what's in there?
It's where the detail lives.
Yeah.
For instance, CONC 2 sets out conduct of business standards. Basic stuff, really, but vital. Treat customers fairly, don't mislead. It prohibits things like targeting people with credit they clearly can't afford, using high-pressure sales tactics, not giving enough time for repayments, or trying to repossess goods without fair warning. It draws clear lines against predatory behavior.
Right. And what about ads? All those credit card offers?
That's CONC 3, Financial Promotions and Communications, all about making sure ads are fair, clear, not misleading. Plain English.
And those warnings, your home may be repossessed.
Exactly. That's mandated by CONC 3. Those crucial health warnings.
Makes sense. What else?
CONC 5 is about responsible lending, making sure providers actually check that customers can afford the repayments. Proper creditworthiness checks.
Which, as you said, was a big issue before, especially with payday loans.
A huge issue. Then CONC 5A and 5B bring in those price caps. We discussed the 0.8% daily interest cap, the 100% total cost cap for high-cost short-term credit.
Okay.
And importantly, they also introduced a similar 100% total cost cap for rent-to-own agreements.
The ones where you pay weekly for furniture or appliances?
Exactly. That cap is based on benchmark prices from mainstream retailers, stopping firms from hugely inflating the price of basic goods. Tackled a real problem area there.
What about overdrafts? They can be expensive too.
CONC 5C and 5D deal with overdraft pricing and repeat use. They demand transparent charges, easy comparison. And crucially, they banned firms from charging more for unarranged overdrafts than for arranged ones.
That was a big change.
There was. And firms now also have to spot if someone's constantly living in their overdraft and step in to help, identify patterns of repeat use, and intervene.
And if someone does fall behind, gets into arrears.
That's CONC 7, arrears, default, and recovery. It requires firms to have fair procedures to treat people reasonably, especially vulnerable customers. This was really important because debt collection, debt administration, those areas were pretty much unregulated before.
Wow. So CONC really covers the whole life cycle.
Pretty much.
Yeah.
And finally, CONC 8 sets rules for third-party debt advisors, making sure the advice people get is actually suitable and in their best interest. It's a really comprehensive protective framework.
It really shows how deeply this stuff, consumer protection, is just woven into everyday financial products, doesn't it?
Absolutely. And connecting it back to that bigger picture, it really demonstrates a clear commitment over many years to try and build a fairer, more transparent credit market.
Which isn't just good for individuals.
No, it's good for the whole economy, really. It fosters trust. It helps ensure credit works as a tool for opportunity, not, a trap.
So to recap, we've gone from the original Consumer Credit Acts through the impact of the EU directive,
Yep.
looked at the FCA's tougher stance,
Right.
and then delved into the specifics of the CONC Sourcebook. All these layers built up over time.
All designed ultimately to protect you, the consumer.
And knowing about these rules, it's not just like academic knowledge, is it? It empowers you.
Definitely. It helps you make smarter financial choices. It means you know your rights. You can navigate things with more confidence.
So what does all this mean for you listening? Well, next time you see an ad for a loan or you're looking at a credit agreement, maybe just take a second. Think about all these regulations working away in the background.
Think about that hidden value, the protection they offer.
And maybe think about, what other steps you could take for your own financial health. Could knowing these rules actually change how you approach borrowing? Or even how you save? Something to mull over.